Welcome back to the deep dive. Today, we're putting away the usual balance sheets
Yeah,
and picking up the tax code instead. We're going deep into how businesses, well, maybe your business, can legally speed up recovering the cost of, big purchases.
right. We're talking Chapter 8 territory today. Mastering depreciation, amortization, and depletion.
And this stuff, it's critical, isn't it? Because the tax rules are often completely different from standard financial reporting.
Absolutely. Tax law dictates these write-offs. So our sources today, they're really focused on giving you a clear, actionable guide. We're zeroing in on the big accelerated deduction chances for 2025.
Okay, so our mission is clear. Understand the rules, but maybe more importantly, understand the traps and the strategies. The basic idea seems simple enough, right? If you buy something that lasts for years, you shouldn't expense it all at once.
Precisely. That's the core concept, the
Yeah.
recovery of capital doctrine. You spread the cost over the time the asset actually benefits your business.
But how you spread it, that depends entirely on what kind of asset it is.
Exactly. So let's get the terms straight first.
Good idea.
Okay, tangible assets. Things you can touch like machines, equipment, furniture, but not natural resources. That cost is recovered through depreciation under a system called MCRS.
MCRS, got it.
Then if you're dealing with natural resources, think oil, gas, timber, minerals, you use depletion.
Depletion for resources, okay.
And finally, intangible assets, things like goodwill, patents, copyrights, maybe software, that cost gets recovered through amortization.
Depreciation, depletion, amortization. Got the three main buckets. All right, let's dive into part one then. MACRS, Modified Accelerated Cost Recovery System. Sounds very official. This is the bedrock for most physical asset write-offs, yeah.
It really is.
So why this separate system? Why didn't Congress just say, use your regular book depreciation?
Well, the goals behind MCRS were pretty specific. Things like encouraging businesses to invest more, trying to simplify the tax rules a bit.
Simplify, huh?
Well, arguably. And a key goal was to accelerate cash flow. So the recovery periods under MCRS, they're usually much shorter than how long the asset will actually last economically.
Right, shorter lives mean bigger deductions sooner. And within XCRS, you mentioned we split things into personality and realty.
That's the fundamental split. Personality first. That's your movable property. Think office furniture, computers, manufacturing equipment.
Stuff you can, like, pick up and move.
Pretty much.
Yeah.
And this type of property gets the benefit of accelerated depreciation methods. Usually it's the 200% declining balance method. These assets fall into classes like 3, 5, 7, 10 years, up to 20.
Okay, hold on. Accelerated, 200% declining balance. What does that actually mean in practice?
It means you get bigger write-offs in the early years. So take a 5-year asset. Straight line would be 20% per year. The 200% declining balance lets you take double that rate, so 40%, off the remaining balance each year, at least initially.
So much bigger deduction in year one compared to just spreading it evenly.
Exactly. Great for immediate cash flow.
Okay, got it. Now what about realty? That's the real estate part.
Right. Boardings, land improvements, that kind of thing. And for realty, you have to use the straight line method. No acceleration here.
Much slower then.
Much slower. Residential rental property, like an apartment building, gets written off over 27.5 years.
27.5 years. Ouch.
And non-residential property offices, warehouses, storefronts, that takes 39 years.
Okay, 39 years. That's quite a while. Now, before we can deduct anything, there's this crucial rule. Placed in service. What's that about? Why isn't it just the purchase date?
Because the tax deduction is tied to when the asset is actually ready and available for its intended use in your business. Not when you paid for it, not when it arrived in a truck, when it's set up and ready to go.
Ready and available. Okay.
And that exact date is super important because the depreciation conventions. The default rule is the half-year convention.
Half year. What does that assume?
It basically pretends you placed the asset in service exactly halfway through the year, no matter if you bought it in January or December. So you get half a year's depreciation in year one.
Seems simple enough. A bit arbitrary, but simple. So what's the catch? You mentioned a tax trap.
The catch is the mid-quarter convention. This thing can bite you hard. It gets triggered if you place more than 40% of the total cost of all your personal, not real estate in service, during the last 3 months of your tax year, the fourth quarter.
More than 40% in Q4. What happens then?
You lose the nice, simple half-year convention for everything you bought that year. Instead, each asset is treated as placed in service in the middle of the quarter it was actually placed in service.
Whoa. So if I buy one big machine in October.
And that machine is more than 40% of everything you bought that year.
Then all my assets bought that year, even stuff I bought back in January, get treated under this different, potentially less favorable timing rule.
Precisely. Let's use that Dr. Payne example.
Yeah.
A dentist buying a big $612,000 piece of equipment. If Dr. Payne gets everything installed and ready by, say, September 29th, just before Q4 starts.
He uses the normal half-year convention.
Right. And his first-year deduction is like $91,000. Pretty good.
But what if the installation slips just a few days? Say it's ready October 3rd.
Now that big piece of equipment falls into Q4. Since it's more than 40% of his total purchases, boom, mid-quarter convention kicks in for all his assets.
And the damage.
His first-year deduction plummets, down to about $34,500.
Wow. From $91,000 to $34,000.
Yep, a $57,000 swing in immediate tax savings just because of a 3-day difference in when the asset was ready.
That is. Yeah, that's a critical planning point. You absolutely have to watch your Q4 purchases.
Ugh.
All right, that timing trap is scary. Let's talk about the ways to really juice the deductions up front, the turbochargers. Section 179 expensing and bonus depreciation.
Right, these are the big ones designed for immediate impact to stimulate investment.
And for 2025, they're looking pretty powerful.
Very powerful. Let's start with bonus depreciation. For 2025, the rule is simple. You can deduct 100% of the cost of a qualified property in the year you place it in service.
100%. So basically write it all off immediately.
Pretty much. And qualified property is broad, most depreciable stuff with a life of 20 years or less. Importantly, this now includes used property, too, not just new. That's a big deal.
Okay, 100% bonus depreciation. If that's available, why do we even need the other one? Section 179 seems redundant.
But they have different rules and limits. Section 179 is also an immediate expensing election, but it's really targeted more towards small and medium-sized businesses. For 2025, the maximum you can expense under Section 179 is huge, $2,500,000.
$2.5 million. That's a massive jump from before.
It is. But there are two key limitations that bonus depreciation doesn't have.
Okay, what are they?
First is the investment limit, or phase-out rule. That $2.5 million maximum starts getting reduced, dollar for dollar, if the total cost of assets you place in service during the year exceeds $4 million.
$4 million.
And if your total asset purchases hit $6,500,000 or more.
Let me guess, the Section 179 deduction disappears completely.
Wiped out entirely. So it really benefits businesses investing up to that $4 million threshold the most.
Okay, that's limit number one. What's the second?
The business income limitation. This is crucial. Your Section 179 deduction cannot exceed your total taxable business income for the year.
Meaning you can't use Section 179 to create a business loss or make an existing loss bigger.
Exactly. It's limited by your net earnings from the business wages, sole proprietorship income, K-1 income from partnerships or S-Corp, that kind of thing.
And bonus depreciation, does it have that income limit?
Nope. That's a key difference. Bonus depreciation can create or increase in net operating loss. So if your business is having a down year or is a startup expecting losses, bonus is often more flexible.
Interesting. Okay, so you have these two powerful tools. How do you use them together? Is there an order?
There is a required order. You have to apply them this way. First, Section 179. Second, bonus depreciation. And third, whatever is left gets depreciated under the regular MCRS rules.
179, then bonus, then regular MCRS.
Got it. Now, is there a strategy to which assets you apply that Section 179 deduction to first?
Yes, and it's a bit counterintuitive. For the maximum time value of money benefit, you should apply the Section 179 expense against the asset with the longest MCRS recovery period first.
Longest life first. Why is that? So if I have a 5-year machine and a 7-year machine, I use my $2.5 million limit on the 7-year one first.
Exactly. Think about it. The cost you don't expense immediately with 179 or bonus will eventually be recovered through regular MCRS depreciation.
Right.
The 5-year asset's cost will be recovered relatively quickly anyway under MCRS. The 7-year asset takes longer. By expensing the 7-year asset first, you're accelerating a deduction that would otherwise be spread out over a much longer period. It pulls the slowest deductions forward.
Maximizing the present value of the tax savings. Makes sense.
Precisely. Now, before we leave these big incentives, you mentioned something special for real estate, which normally gets that painfully slow 39-year treatment.
Yes, this is a really interesting new development from the Omnibus Business Bill of 2025, the OBBBA. It created something called Qualified Production Property, or QPP.
QPP, what does it do?
It allows 100% bonus depreciation for specific manufacturing and production areas within non-residential real estate.
So not the whole building, but the part where you actually make stuff.
Exactly. If you build a new factory or maybe just renovate a section for a dedicated production line, that specific portion of the building structure, which would normally be stuck on that 39-year schedule, might now qualify for immediate 100% write-off via bonus depreciation.
Wow, that's a huge potential boost for manufacturers investing in facilities.
Absolutely. A very targeted incentives to encourage domestic production investment.
Okay, let's shift gears a bit. Talk about some limitations and maybe more niche rules, starting with something called the listed property trap. Sounds
Okay.
ominous.
It can be. Listed property is a specific category the IRS watches closely. Think passenger cars, certain airplanes, boats, computers not used exclusively at a business location, and property used for entertainment or recreation.
Okay, stuff that might have significant personal use. So what's the trap?
The trap is a cliff edge based on business use percentage. If the qualified business use of that listed property drops to 50% or less in any year,
50%. Okay.
you immediately lose access to all the accelerated methods. No Section 179, no bonus depreciation, no accelerated MCRS. You're forced onto the slower, straight-line depreciation method, often over a longer recovery period.
And you might even have to recapture, pay back some of the excess depreciation you claimed in earlier years when business use was higher.
Exactly. It's a significant penalty for letting business use dip too low.
Okay, so keep business use above 50% for listed property.
Got it. Now, even if you clear that hurdle, passenger cars face extra limits, right?
Yeah.
Luxury auto limits. Correct. This applies specifically to passenger automobiles, cars, light trucks, vans with a gross vehicle weight, or GVW, of 6,000 pounds or less.
6,000 pounds or less.
For these vehicles, even if you use them 100% for business, there are strict dollar caps on the annual depreciation deductions. For 2025, the standard first-year limit is $12,200.
12 too. That's not a lot for a new car these days.
It's not. However, if you claim the 100% bonus depreciation on that vehicle, the first-year limit gets an $8,000 bump.
Okay, so $12,200 plus $8,000. That's
Yeah.
$20,200 total first-year deduction if you take bonus.
Correct. That's the max for passenger auto in year one for 2025, assuming you use bonus, though potentially much less than the car's actual cost.
Right, but then there's the famous Hummer loophole or the heavy SUV exception.
Yes. This applies to vehicles like heavy SUVs or heavy trucks with a GVW over 6,000 pounds, but not more than 14,000 pounds.
So bigger than a standard car, but not a huge commercial truck.
Exactly. These heavier vehicles are not subject to those annual luxury auto dollar limits.
So you can write off more.
You can. However, Congress did put a specific cap on the Section 179 deduction you can take for these heavy vehicles. For 2025, that Section 179 limit for heavy SUVs and similar vehicles is $31,300.
31.3 for Section 179 on heavy SUVs. So still a pretty good immediate write-off, just not unlimited 179 like for, say, machinery.
Correct. You get a substantial upfront deduction, but it's capped for the 179 portion. You could potentially still get bonus depreciation on the remaining costs, though.
Okay, that makes sense. One more niche rule. What happens if I convert a personal asset like my home into a rental property or use it for business? How do I figure out the starting point for depreciation?
This rule is designed to stop you from deducting a personal loss through depreciation. When you convert personal property to business use, your starting basis for depreciation is the lower of two numbers. The lower of its adjusted basis, basically, what you originally paid for it, plus improvements, minus any prior depreciation, if applicable, OR its fair market value on the date you convert it to business use.
Lower of cost or market value at conversion. Okay, so let's take that Dr. Payne example again. But say he converted his personal residence. He bought it for $350,000. But maybe the market dipped, and when he turns it into a rental, it's only worth $280,000.
Right. In that case, his depreciable basis for the rental property starts at the lower fair market value, $280,000.
And that $70,000 drop in value that happened while it was his personal home?
That's considered a non-deductible personal loss. You don't get to sneak that personal loss into the business deductions. You start depreciating from the value it had when it entered business service.
Okay, that covers a lot of ground on MCRS and its limits. Let's spend our last part on the other two recovery methods, amortization for intangibles and depletion for natural resources. Let's start with intangibles.
Sure. The main category here is what's called Section 197 intangibles. This includes things you often acquire when you buy a whole business goodwill, going concern value, customer lists, patents, copyrights, covenants not to compete.
that kind of valuable but untouchable stuff.
Exactly. And the rule for these is very rigid. Regardless of how long you think they'll actually last, Section 197 intangibles must be amortized straight line over 15 years.
15 years, flat rate, no acceleration.
No acceleration. 15 years ratably, that's it.
Okay. What about costs you rack up before you even officially open the business? Startup costs, investigating a potential business.
Good question. There's a special rule for startup expenditures. You get a little bit of an immediate deduction. You can expense the smaller $5,000 SAR your total startup costs incurred.
Up to $5,000 up front.
Nice.
But there's a catch. That $5,000 immediate deduction starts to phase out dollar for dollar once your total startup costs exceed $50,000.
So it disappears completely if your startup costs hit $55,000.
Exactly. It's really aimed at smaller startups. Any costs you don't deduct immediately under that $5,000 rule, or if you exceed the phase out, must then be amortized over 180 months.
180 months. That's 15 years again.
Yep. Same 15-year period as Section 197 intangibles, effectively. Okay. Now let's move to the final category. Depletion for natural resources. Oil, gas, minerals, timber. You said there were two methods.
That's right. Cost depletion and percentage depletion. You generally calculate both each year and take the larger deduction.
Calculate both. Take the bigger one.
Okay.
Tell us about cost depletion first.
Cost depletion works a lot like the units of production method of depreciation you might see in accounting. You take your adjusted basis in the resource property, what you paid for it, essentially.
Okay.
You divide that basis by the total estimated number of recoverable units, barrels of oil, tons of coal, whatever it is. That gives you a cost per unit. Then you multiply that cost per unit by the number of units you actually sold during the year.
So it's directly tied to your original cost and how much you extract and sell. Makes intuitive sense.
It does. It ensures you recover your cost, but no more than your cost, over the life of the resource.
All right. Now, what about the other one? Percentage depletion. You said that one was different.
Very different. Percentage depletion isn't based on your costs at all. It's based on the gross income you generate from selling the resource from that property.
Based on revenue. How does that work?
Congress sets specific statutory percentage rates for different minerals. For example, it might be 22% for sulfur, 15% for domestic oil and gas, 10% for coal, 5% for sand and gravel. You name it.
Okay.
You take your gross income from the property, multiply it by the applicable percentage rate, and that's your tentative percentage depletion deduction.
Tentative. Is there a limit?
Yes, there's an important limit. The percentage depletion deduction cannot exceed 50% of the taxable income from that specific property, calculated before taking the depletion deduction itself.
Okay, 50% of net income from the property limit. So calculate both cost and percentage, apply the limit to percentage, and then take whichever method gives the bigger deduction for the year.
Exactly. That's the annual choice.
Now, you hinted earlier that percentage depletion had a unique advantage.
Something about exceeding cost. This is the truly remarkable thing about percentage depletion. Because it's based on gross income, not your original cost basis, your total aggregate depletion deductions taken over the years can actually exceed your original investment in the property.
Wait, you can deduct more than you originally paid?
Yes. With cost depletion, once your basis hits zero, your deductions stop. With percentage depletion, even after your basis is zero, you can keep taking percentage depletion deductions as long as you have gross income from the property, subject to that 50% taxable income limit, of course.
So the basis goes to zero, but the deductions can potentially continue indefinitely based on revenue.
That's the unique power of percentage depletion. It's one of the few areas in the tax code where your total deductions can fundamentally exceed your actual capital investment.
Wow. Okay, that's quite a deep dive we've done there. From MCRS timing traps to 100% bonus, and this idea of depletion exceeding cost. So wrapping this all up for someone listening, trying to maximize their tax benefits in 2025, what's the key takeaway?
I think it's really about leveraging those powerful accelerated incentives strategically. That huge $2.5 million Section 179 limit, the 100% bonus depreciation, these are major tools for boosting cash flow now.
But you have to be smart about it.
Absolutely. You must watch those placed in service dates like a hawk to avoid that mid-quarter convention disaster. And remember the strategy. Apply Section 179 to your longest-lived assets first to maximize the time value of those deductions.
And it's also crucial to remember that grabbing the biggest possible deduction this year isn't always the smartest move long-term, right?
Exactly. That's the ultimate strategic consideration. Acceleration is great if your tax rates are stable or declining. But if you expect your marginal tax rate to be significantly higher in the future.
Maybe because your business is growing fast, or you anticipate law changes.
Right. In that situation, it might actually be better to defer deductions. You could choose to elect out of bonus depreciation, for instance. Use the slower straight-line MCRS method instead.
Why would you do that?
To save those larger deductions for future years when they can offset income that would otherwise be taxed at a higher rate, it's about matching deductions to the highest income years, if possible.
A fascinating strategic layer.
Yeah.
Maximize now or defer for potentially greater future savings.
Hmm.
Okay, a perfect thought to end on there. And, thinking about everything, we covered all the intricate rules, the caps, the timing. It's kind of amazing that maybe the oldest, most basic deduction we talked about, depletion, is the one that has this fundamental quirk allowing total write-offs to potentially exceed what you actually spent on the asset.
It's pretty unique.
It really makes you wonder, doesn't it, what other bedrock tax concepts out there might have similar quirks, allowing you to, in effect, deduct more than your actual economic cost.
That's definitely something worth mulling over until our next deep dive.